Following is an example of a process that can be created using SQL Server integration services for a business that operates standalone companies in different countries and that have a need to present consolidated financial data in accordance with generally accepted accounting principles. In the following example, we assume that the business is being conducted in the United States and Poland, and that the consolidated financial statements need to be presented in US dollars. There are four main objectives: to be able to report standalone results for both business units in their respective base currencies, to create translations by period for non-USD to USD currencies, to create eliminating intercompany entries by period between the relevant business units, and finally, the overarching objective to have one consolidated ledger in US dollars to be used for all consolidated financial reporting. There are 5 basic steps towards achieving our objectives. The first 3 steps are to get and insert general ledger activity from each of the ERP instances from which the businesses are transacting and insert that data into one comprehensive ledger table. The fourth step is to calculate translation rates and insert that information into the comprehensive ledger. And finally, to calculate intercompany eliminating entries and insert those entries into the comprehensive ledger table that you'll have to create in your data warehouse. The ledger table you'll need to create consists of 8 columns. In our example, we're using 3 different companies, so we'll see Pol, US, and Elim. For the GL code, these can be any of the GL codes that are in either of your ERP instances. The GL year and month are the periods in which the GL activity occurred. And then we get to these last 4 columns: amount, currency, base amount, and base currency. This is where all the magic happens. Notice how this amount here in the first line corresponds to the base amount of 500,000 over here. If we look at the ERP currency rate, we can see that there are 2 different rates that are calculated. So if we divide this by this, we come up with this currency rate. If we divide this by this, we come up with this currency rate. In our example, it is presumed that the calculated ERP currency rate that we have right here in the Polish ERP instance at the time of the transactions were different. So at certain points in time, somebody presumably went into the ERP system and changed their currency rate for the alternate currency ledger. Now let's look at the average rate for the end of January. And we see here that we have 293,185. Which we have 293,185 here. Now let's take a look at our sales for the month of January in zloty were 500,000. So if we take the 500,000 and we multiply that by our rate at the end of the month for the average rate, we come up with a US dollar of 146,592.48. So now we go over here and we take a look in period 1. We've already pulled these 2 lines of data out of our alternate currency ledger that get us to 141,380.73. So the additional amount that we're going to ask integration services to insert into our ledger is at 5211.75 to get us up to the 146,592.48. And we can see here that our base amount is 0. So for that period, we see that the 146,592.48 correlates to the 500,000. It's all US dollars. Now we come along to the second month, and we see that we had 775,000 zloty worth of sales for the month of February. And we can see that our rate, our effective rate that was in the system in that time was 0.291545. And the rate didn't change throughout the period of February. So we have an amount that's in US dollars of 225, 947.52 that was already in the alternate currency ledger, that through our first 3 steps for our reporting steps, we brought into our ledger table. So now, if we look at the activity on a cumulative basis for our zloty, our Polish currency, we see that we have 1,275,000 in zloty that we did on a cumulative basis for our sales. Now we look at what our average rate was for the end of February, and we see that it's 0.29624. So if we multiply this currency rate by the 1,275,000 on a cumulative basis for our GL account 4010, we want to see $377,711.83. So we tell integration services to look at what's already in the ledger on a cumulative basis for periods 1 and 2 and take the difference between the 372,540 and the 377,711 and insert it into the ledger, so that what's in the ledger for US dollars for periods 1 and 2 on a cumulative basis is what we want to be reporting for generally accepted accounting principles. Okay, let's talk about the last step, eliminations. Eliminations occur when there are intercompany transactions between the 2 business units. So in this example, we're going to show a sale from the US business unit to the Polish business unit and how those transactions eliminate. So the first thing that you want to make sure that you do is set up in your ERP instances the appropriate intercompany ledgers, and then you'll have to make sure that your GL activity for the period gets into those ledgers before you run your integrated services processes. So you're going to want to set up an intercompany receivables, intercompany inventory, intercompany payable, intercompany sales, and intercompany cost of goods sold. What I'll say about the intercompany inventory accounts is that you may, in your ERP instances, be receiving in inventory to your regular inventory account. Maybe you're not going to have your other business unit mapping received product from that other business unit into some separate inventory account, and then you'd have to transfer it over to your regular operating inventory account. So this might just be a staging account that you have where your accountant would post your intercompany transactions for that inventory just as a journal entry so that they can move it over to your elimination. So here we've got a sale. The Polish business unit bought inventory from the US business unit. So here we can see in period 1, so we're just going to go ahead and select period 1 right here so that we can take a look at it. And then we're going to select for US dollars. So right there, there's our transaction on the US side, on the US business unit. So you've got credit to intercompany sales, you've got your debit to receivables on your balance sheet, and then you've got your cost of goods sold, and then you've got inventory coming out at this cost. So you can see that there's a little bit of markup between the US business unit and the Polish business unit, and we'll have to account for that in a minute. On the Polish side, they receive the inventory in to their inventory. There's the $104,000 at the current conversion rate that was in the system at the time. Presumably, it related to 362,000 zloty. So let's talk about the process, really. The inventory was received in. The supplier, the business unit, the U.S. business unit was set up as a supplier, conceivably, in the Polish ERP instance. And that supplier is transacting with a base currency itself inside of the foreign Polish business unit, but that inventory is coming in at US dollars. And when it's received in, It's actually calculating the zloty amount of the 362 according to the conversion rate inside the business unit, inside the ERP instance for Polish. And then it's converting it over here into the alternate currency ledger. So you've got the $104,000 related to the 362,369 zloty. We've got our translation that's already been done here. So you can see that they've got the translation done here on the payable side and then on the inventory side. So you have everything netting to zero for your transaction. Now let's talk about the eliminating entries. So for this transaction, for period 1, if you look at all of these transactions, just the rule simply says, take the sum of all of these transactions for each of the accounts, flip the sign, and insert it into the ledger table with a business unit of elim. So your insert script and your select script might look something like this. Select elim as company, GL year, GL month, GL code, minus some of the amount from the ledger, or the GL code in, and these are your intercompany accounts, and company is not equal to elim. So if you've already got transactions in there for the eliminating business unit for these GL codes, you don't want to include those in the period calculation. So once we get down here, we have all of this netting that takes effect. So you can see for the intercompany receivable of 10025, we have $104,000, and that corresponds to the intercompany receivable up here. So that is netting out. Then we've got intercompany inventory. This is the tricky one. So you can see that we've got 47,490.22, and that's the sum of these three transactions. So you've got to reverse out the inventory that was received in to the Polish business unit, and then basically you're adding back the cost of goods sold into the inventory. So you're revaluing your inventory is what you're doing, because you remove the inventory at $78,000 and then you deposited the inventory for $125,000. So basically you've got to net those two out. And there it is right there. So if you think about it this way, and the reason why I say that this is the tricky one is because this is the only instance where there's not really a one-to-one relationship between the accounts. So you're actually you're netting the activity between your U.S. business unit and your Polish business unit and creating an eliminating entry into the eliminating business unit. So if you think about it, you put in inventory, you've got a higher value here over on the Polish side of the house than you had over here when it was coming out on the U.S. side of the house. So you're taking away the value on your books and your Polish business unit. You're taking away that value on a consolidated basis, and you're just putting back in the true value, the true cost of the product. So that's kind of what you're doing. So on the Polish books, it's marked up. On the U.S. books, it counted as a sale, but then when you consolidated and eliminated, you went ahead and netted out those amounts so that you're really valuing that transaction, that inventory at $78,000 on a consolidated basis and not some other number. So then we have netting here. So the 125 and the intercompany payables, that nets. We have here some more netting, and intercompany cost of goods sold, that netting also takes place as well. Then we come down here and let's go ahead and pivot everything out. So let's just look, for example, for the intercompany payables and receivables. So in period 0, we can see that the intercompany payables, we had 431,469, and we see that the 431,469 there, and then we have an eliminating entry in period 0 of 431,69. So yay, it nets to 0. Now we go down to the receivables for the same period for the U.S. business unit, and we see that we have 431,469 and a corresponding credit to the same account for 431,469 using the intercompany eliminating business unit. So those two net to zero. Now let's look at what happens in period 1. This is on a cumulative basis because these are balance sheet items. So if we look here, this 557,145 in the Polish business unit, that's the sum on a cumulative basis of all of the intercompany payable transactions in the Polish business unit. And that gets us to the 557,145. And then the eliminating business unit is picking up the 557,145 in the opening balance entry, and then the entry that we added in period 1 when we ran the elimination process. Then we get down here, same thing. So for the U.S. business unit, we've got period 0 and period 1 summed together to get our balance there. We've got the offsetting eliminating balance right here so that we net to 0. Here's a little bit of an interesting observation. So you can see that we're off by exactly 21,676.22, which happens to be, these revaluations that took place at the ledger. And the reason why we've got this reconciling difference between the two business units is that when we received in the product at the 369.34 for the zloty, and then created our payable for US dollars at $104,000. This revaluation, this was a revaluation that took place within the ERP instance, the Polish ERP instance itself. And because we're off by our translating amount, what that tells me is that the Polish business unit technically owes the U.S. business unit $104,000. And within the Polish ERP instance, that $104,000 hasn't been revalued before translations were done. So if you're not an accountant, just trust me on this. That's what's going on here. Once the accountant does the reevaluation in the business unit, then that will get fixed.